Welcome to this week's episode of the CIO Brief. I'm Brad Johnson, Managing Director and CIO of Evergreen Capital. Today, we are going to start with the lesson for my kids that I like to share with our clients and the viewers out there, because not only is it good for them, it's also a good reminder for me, and I think you at home as well. And so today's lesson is, I am an old man and I have known a great many struggles, but most of them never happened. So that is a pretty popular tale about just overly focusing on concerns that are unlikely to happen, and we kind of get caught up in this worry. And I think that's especially applicable to the stock market, to the economy. In fact, today I was reminded of this quote because Jamie Dimon, there was another report of him at a conference. He, of course, is the legendary CEO of JP Morgan, and he's amazing. Like I said, he's a legend. But I see this article every quarter about Jamie Dimon thinks the economy is really slowing down and there's stormy clouds ahead, which may or may be true this time. But like I said, it feels to be an evergreen type of article headline that I hear from him constantly. It's been that way the last 10 years. And this is somebody who, from his perch, right, the CEO of one of the largest banks, I think the largest bank, or at least close with Bank of America, has unbelievable data on the American consumer. So he can see all this transaction data, and yet he has a hard time pegging whether or not the economy is going to go into a recession. So him talking about and worrying about a possible slowdown, if he can't figure it out, I don't think most people have any shot at pegging the future of our economy, the stock market, interest rates, you name it. And so once again, I have known a great many worries, but they've all been in my mind. All right, moving on to this week in the markets, just a quick update on things we thought were interesting. Of course, most of it is noise, but some of it's not. So let's just check in. Stocks had generally a pretty flat week, up about 1.5 points, which is great. More importantly, the 10-year Treasury at 4%, I think is a great sign, especially for real estate investors, for the housing market, and just the overall economy. We need to see that rate stabilize. If it was going to spike to 5%, then I think we would start to see a little bit more, certainly in the economy. The businesses out there cannot continue to pay their debt when rates keep rising. And when the 10-year is super volatile, it just makes everybody a little bit nervous. They stop investing into their businesses. They hoard more cash. They get a little bit jittery in terms of making new purchases and new initiatives. So it's just good to see that 10-year stabilize. And part of that's a function of, the Fed is certainly signaling that they are going to start cutting rates in September. The markets have already priced that in. We've seen the markets be pretty stable this last couple of months, but really the last few weeks, the markets have appreciated in part because they are anticipating several rate cuts now into the end of the year. CPI, that's, the inflation rate, those readings came in pretty solidly, pretty stable. It's nice to see that CPI is stabilizing as well, getting closer to the Fed's 2% target rate. And the big thing that I thought that came out this week was the revision down in jobs from the last 12 months. Well, technically from April 24 to March of 25. The government revised the report down by roughly 900,000 jobs to payroll growth. And so it just kind of reminded me of the people that overly focus on these job numbers. And then yet, a year later, we're apparently off by 1 million jobs. So once again, most of this is noise. And especially if we're looking at to this data, week to week. And when we see a big, scary jobs number, the market reacts, and sometimes people overreact and start panicking about the future of the economy, but we can't even get the numbers right. So 1 million jobs off in a year is pretty crazy to me. So I'm not sure how they're coming up with these numbers, but it's just another reminder that not all the news reported on CNBC is worth listening to. All right, well, that was the quick update for this week on markets. I think we're going to get into update on family office investments. And this is specifically a survey from Goldman Sachs that interviewed 223 family offices. And of course, the family office is generally a wealthy family that has made a fair amount of money with usually one of their companies. An entrepreneur started something, he ended up selling it, made a lot of money, and then started a family investment firm, hired some outside professionals in order to run the family's investments. And so this study, which Goldman does every year, and I try to read because that's our business, is quite interesting. And so I'll pull that up. Okay, so here we have a report on average asset allocation, right? So how are these family offices investing today? And how is that different from a couple years ago, 2023? And so first of all, this 42%, that is their allocation to alternatives. That is private market investments. And that obviously pales in comparison to most retail investors that have anywhere from 1% to 3% allocated to private assets. The vast majority, the 97, 99% of retail money is in just stocks and bonds, pretty vanilla. But family offices, they want some more creativity. They want they want a diversified portfolio. They want some unique income streams, and that's reflected here in these groupings. And what's interesting to me here is not really the increase in public market equities, so stocks. That is just really a function of the tear that markets have been on since 23. 23 was a pullback year for the market, one of the few we've had in the last 15 years. And so then you have, obviously, if the market's ripping, proportionally, the percentages in the other asset classes, by definition, need to default if they did not increase at the same rate. But the decrease here in private equity here is largely proportional across buyout, growth, and venture. Once again, that dramatic to me because of the performance of the stock market. What is more interesting to me is a little bit on the private credit taking a bump up. I think that is going to really continue higher for the foreseeable future. And so that's debt, mostly business debt. We are more interested here in Evergreen Capital at real estate debt. We think that's a compelling asset class that we'll be allocating to for a long time. But we think that most family offices are going to start pouring more and more money into private credit, specifically these debt investments, because you're getting a great yield relative to the risk, right? You're taking less risk in debt, and yet the yield has almost equity-like returns. That's a pretty good trade-off that you usually don't get in markets. And we also think that with fixed income, interest rates on bonds, those are likely coming down or could be under pressure, but given all of the debt we have, it's hard to see interest rates going back to near 0%. And so we think more and more people, more and more family offices are going to trade out of their fixed income assets into higher yielding debt assets over the next 10 years. A little spike here in private equity or private real estate and infrastructure. That is probably more infrastructure. I don't think that the last couple of years, family offices are suddenly really boosting their exposure to real estate. They were already pretty fairly allocated to real estate, and real estate's had a tough go the last few years in many asset classes, namely office, a little bit industrial, and multifamily apartments. And so that's probably family offices getting a little bit more comfortable with infrastructure. And so think about the push into data centers. That is a giant wave. That's a big trend. And the investment world has decided to categorize data centers as digital infrastructure. So I think that's largely what's driving that increase in private real estate and infrastructure. Hedge funds, I actually think we're going to start to see a little bit of resurgence in hedge funds. We'll see. It's TBD. They definitely have been out of favor the last 20 years, but really there's been a few of the large hedge funds that have kind of figured out a better business model in that world. They've reduced the volatility. And if we no longer are having these 20% stock market ripping bull markets, which, who knows, we may or may not, but it seems unlikely given where valuations are. Then all of a sudden, something that is a little more hedged, something that has a little more protection to the downside could get interesting. And I wouldn't be surprised if we started to see that pick up a little bit, but never to the glory days of the hedge fund world where family offices had 20% of their portfolios in hedge funds. I think that era is long gone. All right, so that I thought was fairly interesting. What else we got in this report? And we've already segmented this down to just a few pages that we wanted to comment on. So don't worry, we're not going to take you through a 70-page report here. But here we have, what is your primary approach to alternative investments? And so this just gives you a flavor of how do these family offices invest in these particular asset classes? Do they do it themselves? Do they invest with third-party managers, sponsors? Do they just decide that they're not going to allocate to that asset class? And so this gives you a breakdown here. And just to highlight a couple of these segments, I think The private real estate one is interesting because I think family offices, they just feel more comfortable with real estate. If they were an entrepreneur, maybe they own their manufactured building, maybe they worked in an office, everybody lives in residential real estate. So I think it's just an easier asset class to understand. And so family offices have a tendency to be more comfortable going direct and actually buying the asset themselves and running it themselves versus giving it to a private equity real estate manager to do it on their behalf as a limited partner. And so 33% here is in investing through managers. That would either be in a fund or into a one particular property with a sponsor. And then what else is interesting on here? Oh, we've kind of talked about infrastructure. Obviously, it's very difficult to invest directly into a $300 million data center or a dam, a $1 billion dam that has hydropower. Private credit is a little easier to do some loans, of course. What else we have here? Venture capital. I think it's really easy to invest in venture capital because you're pretty much lighting 90% of the checks on fire. And they're smaller check sizes, and it's kind of fun. So, when you're getting pitched new ideas that might change the world, it's kind of fun. So family offices in general tend to like to dabble at least in angel investing. They might add some funds from the larger firms like Sequoia, right? Because Sequoia's got great reputation, great access. If you're already one of Sequoia's or one of these, top 10 brand name VC funds, you're going to continue to invest with them forever because they've basically beaten the system. They get a superior deal flow, and you don't want to get out of those funds if we're lucky enough to get into those vehicles to begin with and build that reputation or relationship with those managers. All right, so I thought this was interesting. Nothing else on this slide. Looking ahead, how do managers think they're going to be allocating in the future here? We have 38% expect to increase their allocation to public equities. That's interesting because I do think, as I mentioned before, it's a little rich. I would suspect that, or I would have thought that most investment managers are not increasing their allocations to the stock market at this point, but this report suggests otherwise. People have been talking about private equity might be in a challenging period because distributions might not be as high as they have been historically, and therefore family offices and endowments and pension funds are not going to allocate as much to private equity. This report suggests otherwise. Cash and cash equivalents. This makes sense to me. I think people are ready to start making more investments. A lot of cash has been sitting on the sidelines, and that's because it's been earning a really healthy yield, right? It was earning 5% for a very long time. And now, which historically is quite attractive over the last 20, 30 years, that's a healthy yield. And now, of course, we see the 10-year go down to 4%. It looks like the Fed's going to start decreasing. So people are kind of getting ahead of those upcoming Fed cuts. Private real estate. Yeah, not surprising here that people aren't overwhelmingly looking to allocate more to that space, given, people tend to follow the herd. If private real estate has not done well over the last 5 years, which it hasn't, if you look at all the asset classes, there are segments that have done quite well, like affordable housing. And data centers have done pretty well too, of course. But if it hasn't done well in the last 5 years, people people have a hard time getting excited about making new investments in that space. They kind of think the trend is just going to keep continuing. Of course, counterintuitively, that often is the best time to invest. But anyways, all right, what are you positioning your portfolio for in the event of tail risk? So this goes into my worry theme here. And people are worried. People running family offices are a little nervous. They are starting to think about investments like gold, which has been on a tear. They are starting to hold harder assets. They are starting to nibble into cryptocurrency, which is a trend that I think is fascinating, and we'll pick it up here on the next slide. So you can start to see people's nerves pick up with their portfolio and managing tail risk here. All right, speaking of digital currency, speaking of cryptocurrency, it's interesting here to look at a family office and their appetite for Bitcoin and what Bitcoin and perhaps Ethereum, how that has changed over the few years since 2021. In 2021, 40% are not interested at all. This is, once again, out of 230 roughly family offices. They think it's rat poison, as Warren Buffett quoted, and they don't want to touch it. 45 are kind of, hey, yeah, we're intrigued. We might look at it in the future. Not now, though. And 16%, a tiny fraction here, had actually made an investment in cryptocurrency at the time. Then you fast forward to 23, when Bitcoin goes from 60,000 to 16,000, has a bit of a crash, just like the stock market, specifically the NASDAQ, technology stocks, unprofitable software companies obviously tanked in 23. And so then all of a sudden the not interested, spikes from 39% to 62%. Once again, that theme of just looking at recent history and assuming the trend continues is a very human, it's a very human emotion. And then all of a sudden, you have 2025 when, oh, wait a minute, cryptocurrency, Bitcoin specifically, has been on a tear. It's 115,000, I think, as of this week. And family offices are, wait a minute, maybe this is a thing, and maybe we do have too much debt as a country. So I think it's kind of interesting to see the progression of Bitcoin and the attitudes of family offices over the last 4 or 5 years here. But you can see there is a trend, certainly up and to the right, on family offices owning some cryptocurrency, at least a small percentage. I'm not saying these firms are piling in 25% of their portfolio. Of course, they're starting to dabble. They're putting their toe in, which I think is pretty appropriate. And it'll be interesting to see if that continues. Part of this is just a function of, as you can see on the pie chart here on the right, of it getting easier to hold Bitcoin, where you have a listed ETFs. You can buy it through Fidelity. You can buy it through these brand name custodians, Charles Schwab, and you don't have to hold it in a digital wallet, which is tough for, say, a 65-year-old CIO of a traditional family office. So anyways, I thought this was interesting. Down here, I don't really have any major takeaways. This is just by broken down by region, Americas, Europe, and Asia Pacific. There are different breakdowns on how they're thinking about cryptocurrency. Now, this to me is interesting in that you've probably heard this concept of wealth gets accumulated by the entrepreneur or the first member of the family that kind of goes out and achieves a bunch of success. And then gradually that wealth actually fades away once you get to the third and fourth generation. And that's reflected here a little bit in this, who's actually, running these companies. I mean, of course, part of that is just people getting older, retiring and passing away. But it's interesting to me that, you have the beneficial principal or owner of the family office here. 54% are the actual original wealth creator, so that's first generation, and then it continues to go down, right? And so there's very few family offices here that are on their fourth generation. And a little bit of this is the whole point of having a family office to begin with, is that if you do bring in outside professional managers that are less tied to the actual individual wealth that they're managing, it sometimes helps it get a little less emotional. Sometimes they can be more professional and diversified with the portfolios, take the wealth more seriously, treat it as the serious topic that it deserves, versus, somebody that didn't earn the money, making frivolous decisions, doing kind of crazy investments, and spending goes through the roof. Anyways, I thought that was somewhat interesting. And then the last point here, and we'll get off this detailed family office breakdown. But when people hear family office, they think, oh, you have to have 50 people, 30 people running these investments and these crazy accounting divisions, and it's this giant team. But actually, you can do it with a lean group of people that are just focused on making the best investments for that family or for the clients of that family office. And so here, most family offices have fewer than 5 employees. The middle ground is kind of 5 to 10. And you can see here that the average wealth by family office, the average net worth. And you can see at the top here, when you're looking at by the total net worth of these family offices, what percentage have the entire investments managed in-house, so with their team, and what percentage have the investments managed third party or outsourced. And the ones below $1 billion have the majority of their investments managed in-house, but you can kind of see how, well, we don't have enough resources to do it 100% ourselves, so we do outsource some things. And then when you get into this category of the uber wealthy, they can take on more of that in-house with their giant teams. All right, and last point here is the concerns that family office, the worries that they have right now are really geopolitical. That is top of mind for them. And 61% here are worried about conflicts. They're worried about Ukraine. They're worried about the conflict in the Middle East. They're They're concerned with tariff policy from Trump. They are worried China's going to invade Taiwan. And everybody's worried about all these things. I just like the framework that Bill Miller, who is a legendary investor, came up with. And somebody asked him if what he was worried about in the markets, and he would always say nothing. I'm going to let everybody else worry about all of these things that may or may not happen. I'm going to focus on making great investments for the long term because that's something I actually control and is a productive use of my time versus fretting about a million things that may or may not occur. So full circle, bringing it back to the lesson from the intro. And with that, we will go to Q&A, just a couple questions, and we can wrap up for the CIO brief for today. Jesse, what do you have for us today?
So with their investment focus kind of decreasing in real estate debt, do you see this trend bouncing back, or do you see it holding constant for the next several years?
Yeah, so I think the trend, it showed that they were adding more real estate and infrastructure. Now the point there is that how much of that was real estate and how much of that was infrastructure. And I think the majority of that increase from 9 to 11% is what I think it said is going to be infrastructure. The data centers that people are plowing money into because they are very excited, of course, about AI coming and the need for more power, compute in order to service all of these large language models. That's really the main constraint that we have as a country right now is the lack of power and the infrastructure to be able to hold all these servers. And so, yeah, real estate and infrastructure has gone up, but I think that is mostly infrastructure and not traditional real estate. So that's office, hotels, apartments, industrial, retail. I think that's been fairly flat.
All right. Yeah, I've done some research on alternative energy investments, and it looks like we're going to need to be generating a lot more energy storage, so that could be part of it too. My next question was about crypto. So I was wondering what percentage of um, the new acceptance of cryptocurrency do you think is related to political backing versus maybe just familiarity with crypto? It's been around a little bit longer. We're more used to talking about it in our investment conversations.
Yeah. No, I mean, I think it all plays towards that growth. I mean, when the president's family is going out and they're starting some crazy token, I think people are like, wait a minute, this actually might be a thing. This might be around. I personally don't love it. I think it's kind of a distraction that the family is pursuing these avenues within cryptocurrency. I personally, I like the concept of Bitcoin. As a real estate investor, a former real estate operator, I love the concept of a fixed supply with growing demand. So I think it's all of the above. I think it's the acknowledgement that or the realization that we're not going to stop printing money, we're not going to stop spending, we're not going to have fiscal discipline in our government. And so people are, seeing their money get inflated away. They're seeing the prices increase at the stores and realizing that their dollar is not going, as far as it did just a few short years ago. Whereas Bitcoin continues to increase. So, I have no idea whether or not it goes to zero or $1 million in 20 years. Who knows? But I do know that it is gaining in popularity and people seem to like it. And institutions are getting more comfortable with it as digital gold. So I do not frown on anybody having a little bit of allocation to Bitcoin cryptocurrency in their portfolio. What I don't understand is we'll call it the SHIT coins, the 5,000 other random tokens and coins and projects I've never heard of and don't understand. I'll never get that. That kind of just goes into like, look, we want to focus on quality assets. I think if you're going to allocate to cryptocurrency, there's like one or maybe three quality assets. Once again, I'm not an expert, but yeah, I think it's all the above.
Okay, I guess last question there is how much are you at Evergreen focusing on migrating more towards cryptocurrency?
Well, it's a function of what our clients are comfortable with. I think a lot of firms don't want to touch it. They feel it's a third rail. I'm more agnostic. It's not that I want to see a bunch of our clients have it and say, yeah, go. make this 10% of your portfolio. It's more of a function of the client's goals. Like, what are they trying to achieve? Are they comfortable with a few percentage points in their asset, almost as a flyer? If you think about it as insurance, almost like bozo insurance from the government printing too many of our dollars and inflating it away. If you treat it as insurance, which, insurance, you make all these payments, these premium payments into something you may or may never use someday. I mean, hopefully, God forbid, you don't need to use your insurance policies. You don't have an accident. Your car doesn't crash. You don't have to use the hospital for these big payments. I kind of hope that Bitcoin goes to zero someday and we find fiscal discipline and we don't print away, inflate away the value of our currency. But I don't think so. I think that the only way we're going to get rid of $37 trillion of debt is by de facto inflation. I think we're going to do a technical default on our debt because we're not going to come up with a discipline in the government to actually deal with entitlements, Social Security, Medicare, or our spending. We're just going to keep spending it away. So Bitcoin is a bit of a hedge against that outcome. And so I think we might end up having to need that insurance. So that's why I don't mind if somebody has a small percentage that they could afford to lose. What I think it is crazy is when I hear about these seemingly brilliant people that will put 100% of their net worth into this thing. And that's insane. Or even 50%. That's maybe if you can survive off the other 50%, you have, a lot of money and you're doing great and it goes to zero and you're still fine. But I think it's irresponsible, especially if you're a family man and you're the head of the household responsible for your family's future. That's probably irresponsible, and I come across it a surprisingly high amount. But anyways, I kind of got on my soapbox there. But yeah, we don't hate it. We're not obsessed with it. We think that it's totally fine to have a small percentage of it in your portfolio because, frankly, it's not all that different than gold to me. Gold is an unproductive asset, except in very edge cases and of course jewelry, but it's really not generating any cash flow. We were valuing gold based on what people think it's worth. It's just a made up number. It's just a metal. Bitcoin's kind of the same way, but the world has decided, like famous pieces of art, that this is valuable and we're ascribing value to it. And so who am I to call the market stupid? So we'll just kind of continue to watch it. And once again, it's fine to have a little bit of exposure, but don't get crazy with it.
All right. Thank you. Sounds like
Yeah.
we got a rational leader here at Evergreen Capital. Thanks, Brad.
Well, we'll see about that. All right. Thanks, Jesse. All right. Thanks, everybody. Take care.